Hi, this is Ada. Let's talk about how to do tax planning now. After we already studied what is tax planning. All right, keep in mind that tax planning is for your whole financial goal. We do tax planning not just for tax, it's for your total goal. Also, one idea to keep in mind is we do tax planning. We have the short-term goals. It's also very important to serve your long-term goals. Some people often thinking, okay, tax planning is not for me. It's only for those ultra rich. True and not true. Ultra rich, they have often they have complicated tax planning and have a whole group of people helping them. But remember, 95% of the tax code is to reduce your tax. Many of them, those codes apply to you. If you check any of the following box, very possible you will need a tax plan, and tax plan will save you money. Okay, if you have a retirement account, 401k, IRA, Roth, or if you don't have any of those but you're eligible to any of it, think about it. And if you own investment, stock, bonds, mutual funds, have a close look at tax perspective. If you receive stock or stock option from your work, the tax treatment for those stock options can end up very different financial results. And if you own a rental property, and you have a job and you also have a side hustle, so it's a W-2 and a 199 combination, and there's many opportunity to do tax planning. Of course, if you own a business, you're a business owner, or you own slides of business as a shareholder or as a partner. If you donate to charity often, there's many vehicles can help you. And you have sold or you plan to sell your home, your business, your rental house, or big chunk of your stock, definitely think about tax. Or if you says, I don't have any of those, but I will have it in near future, tax planning will also helps you. Tax planning strategy 101. 101, usually it's a simple, basic, but necessary. Strategy number 1, avoid the penalty. The tax deadline every year, we know we need to file our tax before the deadline. And if you fail to file, there's a 5% each month's penalty, up to 25%. And you might think, okay, I just file an extension. True, but the extension only extends your date of file. It didn't extend your liability to pay your tax due. So remember, when you need to file extension, also attach estimated tax check to the IRS. Okay, fail to pay, it's 0.5% each month. People might think, okay, I will never forget. I always file my tax on time, and it might be true if you most of your income is from the paycheck. The tax withhold usually is higher than your obligation. But if you have a side hustle or you sold major assets this year, very possible your withhold is lower than your tax liability. And if you don't pay attention, it will end up paying the penalty. So 101, just avoid the penalty. All right. Tax planning strategy 102. Get all the credits you're eligible. All right, here is not a complete list of tax credit. remember the tax code, the big chunk of the tax code is to reduce your tax. Many in form of giving you tax credit. So there's lots of credit, like the credit for child tax credit to encourage people to have more children. The American Opportunity Tax Credit is for education, earned income tax. It's for moderate and low income taxpayer to encourage them to work more. Family dependent credits, income saving credits, foreign tax credit, homeowner credits, EV credits, healthcare credits. The list just goes on. If you file tax on those kind of tax software like TurboTax or Tax Act, those software, some of the credits it's easy to capture, like child credits, but some credits you need to submit certain documents in order to get it. If you're not a tax professional, very often you will miss out some of it. And also when your life situation change, some credit you don't apply to you before, but it applied to you now. So it's worth to have some professional to look at your situation to see if you capture all the credit, you are eligible. All right, tax planning strategy. For some people, they says, okay, wage W-2 is all I have. I don't have room to do much. It's not true. Let's look at some aspect you can do things. All right, tax deferring account. If you have a 401k account, if you have an IRA account, how many you contribute to those accounts to defer your tax liability. The time and amount, it's a moving art. The main idea is defer part of your income when your tax rate is very high to, like when you retire, you think your tax rate might be lower. And those balance act. And also when you after you retire, how you withdraw the money from those accounts can differ, can lead some different tax treatment. All right, Roth IRA and Roth convention. So the Roth account, you can only contribute the after-tax money, but the beauty of it is after you contribute to Roth, the gains are tax-free forever. Roth conversion, it usually happens like when a year your income is low, maybe you go back to school, maybe you just take a break from work, and then you do the Roth convention on those years, so you change your tax defer money to tax-free account. For the long run, it can make a huge difference. College plan. College plan, the most common one is 429 plan. Similar, you contribute your after-tax money to those plans, but any growth in that plan is tax-free as long as you spend on qualified spending. All right. Also, you might have some investment. Either you are day trading or you hold some bonds. The different instruments have different tax consequence. So how you choose and put them together, it's something worth looking into. And in Bay Area, many people has stocks or options from work. Lucky you guys. It's great, but those stock option composition can be complicated on the tax side, like the stock ownership plan, the incentive stock option. So when you should exercise your option, when should you sell your stock, the timing and how you do it can differ from the ordinary income, which ends to a very high, probably very high tax bracket, or it could be ends on the capital gain, which is favorable tax rate for you. And also charitable contribution. There's some vehicles you can use to do good at the same time to utilize. For example, if you are on the border of itemized deduction and you use a charitable vehicle like donor advised fund to bank 3 years, 5 years of your charitable donation, let it happen in 1 year, and then you can take advantage of itemized deduction. So look at it. Even you only have W-2, that's many things you can utilize. All right. And if you are investors, and I believe many of you are, if you're investors, the first thing you should think is the long-term capital gain versus short-term capital gain. It's 1 year and 1 day. It's a cutoff. And if you hold investment more than 1 year to 1 day, it's long-term gain or loss. And it's a favorable tax rate. All right. And second bullet point, okay, act accordingly when market is up and market is down. Nobody likes when the market goes down, but any situation will give you opportunity. So for the tax word, when the market goes down, it's a good time to do tax loss harvesting. What is tax loss harvesting? Let's give this example. When, for example, if you like say if you hold Google, and then in 1 year the Google is go down, you have like 5,000 loss, unrealized loss, but you believe Google will go back and grows much more in the future, and you still want to hold this stock. But what you can do is you can sell Google at a loss, and at the same time find a similar stock, which you maybe might be Microsoft or Facebook, and you put the money from a sales of Google stock to the different but similar stock. So in that way, you're harvesting 5,000 loss, but you didn't lose your opportunity to still investing in the future. Another way is you can wait a month and buy back Google again. That's tax loss harvesting. If you use this wisely, it's really powerful. And on the opposite side is tax gain harvesting. What's that? So oftentimes when for some years your income is low for different reasons, maybe you take a break, maybe you go back to school, and you don't have the high paycheck as before, but you have some gains of your portfolio, and in those time, it's a good time to sell the winning stock to harvesting the gain. Since when your income is low, the long-term capital gain tax rate is even lower. In those years, you can harvesting the gain, and of course, you can buy those stock back after you sell it. All right, next bullet point, tax efficient investment. Different investment vehicle has different tax treatment. Muni bonds and stock is different tax treatment. ETF and mutual fund, the tax sequence is different. So understand each vehicle you're using and make a portfolio which works best for you. Also, last bullet point, match investments with right account type. All right, we have tax deferring account like 401k IRS. We have tax-free account, Roth and 509, and we have taxable account. If, for example, if you really like to do active trading, which will lead hopefully lots of tax short-term gains, it's more suitable to do it in your tax-free account like your Roth account. Move to the real estate investor. For real estate investor, depreciation is king, and there's a different type of depreciation, understand, and choose the one works best for you. Cost segregation, won't dive too deep on that. It's basically say, okay, a house is a house, but house is house and windows, carpet, landscaping. So we separate those and put a different category. Some category depreciate faster than others. In that way, the real estate owner can depreciation their property faster. All right, capital expenditure decision. Okay, when and how much to spend. So you can have the favorite depreciation. It's 1031 exchange, like-kind exchange, which it's also a form government encouraging real estate investing. This basically says if you sell your property in gain, but you reinvest it to another likewise, like-kind property, your gain is deferred. Some guru in this field, they just keep doing exchange, so they defer their gain again and again, and their portfolio just grow from a small property to big property to bigger property. That's a take advantage of this tax code. Also, there's some opportunity zone fund, which also come from the government want to encourage investor to invest less developed areas, so they give tax benefit. And do it, you can do the society good as at the same time get lots of benefit. Last but not least, charitable. All right, charitable contribution. It's great, and it's also great for tax purpose. As we mentioned a little bit before, donors advanced fund, those are not very high hurdle. Charles Schwab, Vanguard, many those firm has a donor advised fund, and most you can down online. So the beauty of it is you can bundle several years of charitable contribution, and to realize it in one year, in one tax year. So in that way, your itemized deduction will be saving your total tax. And I really like the charitable aspect of it, because what I observe is when people get tax benefit, they usually tend to giving more. So it's a win-win. It's win for the society because they got more funding to do what need to be done, and the taxpayer is happy. And if for some family who established quite a fortune, they can even consider family foundation, which give them more control of what charitable activity they want to operate and develop. All right, this is a very brief presentation about tax planning, and one disclaimer: this presentation is very conceptual, and every taxpayer is different, and many aspects of your tax can interact. So consult a professional before you make some big decision. And thanks for watching, and remember, achieve your financial goal. Tax planning is a very important tool. Thank you.